Hello everyone, this is Doc from the Wealth Boardroom. Welcome to the channel. Today we're going to explore the fascinating world of commodities and how they can play a crucial role in building generational wealth. In the realm of investment, commodities often serve as a robust pillar in diversifying portfolios, providing a cushion against the volatile nature of other investment avenues. So, buckle up for an enlightening journey into the intricacies of investing in commodities. Stay tuned as we delve into this exciting topic. First things first, what exactly is a commodity? A commodity, in the simplest terms, is a basic good used in commerce that can be interchanged with other goods of the same type. These are often resources that come straight from the earth or are cultivated from it. Think of commodities as the building blocks of the products we use every day. For instance, grains like wheat and corn are commodities. They can be used to make a vast array of products, from bread to biofuel. Gold is another commodity, used in everything from jewelry to electronic components. Beef, oil, and natural gas are also commodities. They all have a universal value and are traded on the global market. These commodities are the raw materials that industries around the world depend on. They are essential to our modern economy and play a pivotal role in shaping global trade. Now that we understand what commodities are, let's explore how to invest in them. Investing in commodities isn't as daunting as it sounds. It's a world of opportunity that opens up once you understand the basics. So let's dive into the different ways you can invest in commodities. There are primarily three ways to invest: futures contracts, stocks, and ETFs. Each of these investment methods comes with its own set of pros and cons. First, let's talk about futures contracts. These are legal agreements to buy or sell a particular commodity at a predetermined price at a specified time in the future. Futures are a pure play on commodities, but they can be risky for inexperienced investors. On the bright side, they offer high leverage, which means with a small amount, you can control a large quantity of a commodity. Next up, we have stocks. Now, you might be thinking, wait, I thought we were talking about commodities. Well, investing in stocks of companies that produce commodities allows you to indirectly invest in commodities. For instance, if you invest in a mining company's stock, you're essentially investing in the commodities they mine. The advantage here is that it's a more familiar investment method for most people, and it's less risky compared to futures. But remember, you're also exposed to the company's operational risks, not just the price of the commodity. Lastly, we have ETFs, or exchange-traded funds. These are investment funds traded on stock exchanges. There are ETFs that track the performance of a specific commodity or a group of commodities. ETFs provide a simpler way to gain exposure to commodity price movements without having to own the actual commodities or deal with futures contracts. They offer diversification and are a good option for beginner investors. However, like all investments, they come with their own set of risks. Understanding the commodity market is key to making successful investments. So there you have it. Futures contracts, stocks, and ETFs. Each offers a unique way to invest in commodities, and each has its own advantages and disadvantages. The key is to understand these methods and choose the one that best fits your investment goals and risk tolerance. The commodity market, like any other market, has its own quirks and characteristics. At its heart, it's a stage for the timeless dance of supply and demand. When supply outstrips demand, prices fall. Conversely, when demand outpaces supply, prices rise. Simple, right? But the plot thickens when you factor in variables like geopolitical events, weather, and economic indicators. Take oil, for instance. A political conflict in a major oil-producing region can disrupt supply, causing prices to spike. On the other hand, a bumper harvest can flood the market with a commodity like wheat, leading to a drop in prices. Economic indicators also play their part. Inflation, for instance, often leads to higher commodity prices as investors turn to real assets like gold in search of a safe haven. Now that you have an understanding of the market, let's look at different types of commodity investments. Commodities are not a one-size-fits-all kind of investment. The commodity market is a vast and diverse field, offering a variety of investment options. Let's delve into some of these. First up, we have precious metals: gold, silver, platinum. These are all considered safe haven investments, often sought after during economic uncertainties. Next, we have energy commodities. These include crude oil, natural gas, and coal, the fundamental building blocks of our energy-dependent world. Then there's agriculture. Everything from corn, wheat, soybeans, to coffee and cocoa falls under this category. These commodities are essential to our daily lives and offer interesting investment opportunities. Livestock commodities include live cattle, hogs, and poultry. These are influenced by factors like feed prices, weather, and global demand. Lastly, we have industrial metals like copper, zinc, and aluminum. These are crucial to manufacturing and construction industries, and their demand often correlates with global economic growth. Each type of commodity investment has its own set of advantages and disadvantages. It's all about finding the right fit for your investment strategy. Investing in commodities has its share of highs and lows. Let's start with the highs. 1. Commodities can provide your portfolio with diversification. This is because commodities often have a low correlation with stocks and bonds. 2. They can serve as a hedge against inflation. When the cost of goods rises, commodities usually follow suit. 3. There's potential for high returns. When demand outstrips supply, commodity prices can skyrocket. Now, let's talk about the lows. 1. Commodities can be highly volatile. Prices can swing wildly based on factors like weather patterns and political unrest. 2. Geopolitical risks can impact commodity prices. Conflicts or trade disputes can disrupt supply chains, causing prices to fluctuate. 3. Investing in commodities requires specialized knowledge. Understanding factors that influence prices, from weather patterns to economic policies, is crucial. In summary, while commodities can offer diversification, inflation protection, and high potential returns, they also come with high volatility, geopolitical risks, and the need for specialized knowledge. Evaluating a commodity and its price is an essential skill in commodity investing. Evaluation is a crucial step in the investment process. When it comes to commodities, the evaluation is primarily based on supply and demand factors. For instance, if the demand for a particular commodity, say silver, is expected to rise due to industrial growth, and the supply is likely to be limited, the price of silver may increase. Therefore, investors could consider buying silver now to sell at a higher price later. Geopolitical risks also play a significant role. For example, if a major oil-producing country experiences political instability, it could affect the global supply of oil, pushing prices up. Investors who can predict such events may stand to gain. Then there are other factors, such as weather patterns for agricultural commodities, economic policies, and technological advancements. All these factors can affect the demand and supply of commodities, and consequently their prices. Speaking of prices, understanding and interpreting commodity prices is another essential aspect of evaluation. Commodity prices are often quoted in standard units. For instance, oil prices are generally quoted per barrel, and gold prices per ounce. The prices can fluctuate based on numerous factors, including the ones we just discussed. Therefore, investors should keep an eye on these factors and adjust their investment strategies accordingly. Remember, investing isn't about predicting the future. It's about making informed decisions based on available data and trends. Investing in commodities also offers some tax advantages, but more on that in the next scene. Stay tuned. Investing in commodities is not just about the immediate returns. It's a strategic move that offers significant tax advantages. For instance, commodities are considered long-term capital assets, and their gains are taxed at a maximum rate of 20%, lower than the ordinary income tax rate. This means more of your earnings stay in your pocket, but that's not all. Investing in commodities can also help you build generational wealth. It's a long game, but one that can pay off in spades. By consistently investing in commodities, you're not just increasing your wealth, you're creating a financial legacy that can provide for your children, grandchildren, and beyond. So consider diversifying your portfolio with commodities. It's a smart move that can offer immediate benefits and long-term rewards. Remember, wealth is not just about the money you have now, but the wealth you can pass on to future generations. Investing in commodities might seem complex, but with knowledge and understanding, you can navigate it successfully. We've covered what a commodity is, how to invest, and the functioning of the market. We've also dived into the types of investments, pros, cons, and tax advantages. Remember, evaluating a commodity's price is essential, and with these tools, you can build generational wealth. Thank you for joining me today. If you found this video helpful, please subscribe to the Wealth Boardroom for more insights into wealth building. Until next time, this is Doc signing off.